Hello, everyone, and welcome to BFW 2401. This is the final part of Lecture 1, Semester 2, 2023. Now, in this part, we will talk about regulations. And let me pause for a little bit here. See, regulations, we will touch on it as long as we go, as we progress in the unit. But when we come to the capital adequacy, which is in week 11, week 10, in that week, we will talk about the international regulations. And when we come to week 12, we will comprehensively talk about regulations in terms of the regulator, in terms of the standards, in terms of the process, in terms of the systems. It will give us a good picture. What we are going to do today is to talk about regulations in this part in terms of an overview of the regulation, but it's not the full regulations. So as I told you, as we progress, we will cover all this issue of regulations, which is a very important part in the banking system. This, as I said, are very, very highly regulated institutions, the banking institutions and the financial institutions, especially those DIs, depository institutions who receive money from the public, because there are so many consequences if the banks are not performing well. They can damage the economy, they can damage shareholders, they can damage the savers, and they can damage even people who are not involved, what we call them negative externalities. Negative externalities means if the bank fails, it may destroy the whole economy, destroy businesses, destroys the well-being of the whole community, even if they are not depositors or shareholders. And therefore, I want you to look at the regulations from this perspective. Now, if you allow me to share, I will try to go fast over it. So as I told you, now we are talking only about one part of regulations, which is actually coming from this perspective. See, we already talked about it, and we talked about the special services that banks provide. We talked about this, and we talked about this. This is the 9 items which we talked about in part 2 in this week lecture. So we talked about general areas, and we talked about institutional specialness. These are 9 areas. Now, just assume for a while what would happen if the liquidity services, a bank has liquidity problem and they fail to give the people their money in time as they requested. So that means they don't honor their liquidity requirement. There will be a bank run, and the bank run means everybody, even if they don't need the money, they will go and start to withdraw their money. And if that happens, the bank may collapse and ripple effect starts. Other banks will collapse, the whole economy will collapse. It depends on the size of the bank. Also, if they make a lot of risks and depositors started to lose their money, this is also another problem. So regulators want to be sure that these services are actually provided in a way that is acceptable, in a way it keeps the bank surviving and the economy running. And therefore, regulation comes from this perspective. Remember, if you are talking about another a business corporation, for example, take I don't want to talk about Sunway, but let's talk about Sunway, for example, as a corporation, or Sime Darby, or IGM, or any of those companies, big companies. If they collapse, there will be a damage, maybe a little bit to the sector, and to the employees and to the shareholders. But if public bank now collapse or Maybank collapse, just imagine the damage that they will create to the economy, the local economy, regional economy, and this is why we have the financial crisis, the Asian financial crisis in 1998. It's just one small bank, collapse in Thailand. Global financial crisis, Lehman Brothers, when they collapsed, most banks in the US collapsed, and then it spread all over the world. It's just this ripple effect because of these connections among the financial institutions, and also connections among financial systems of countries and sectors. And therefore, why it is important? Because I just give you two things. Negative externalities, and I want you to understand this. Negative externalities is if the banks did not provide those services as they are supposed to, and they failed to do that, and that created a problem that led the bank to stop the payment system or stop paying for depositors. Now, if the bank collapses, then it will affect the whole economy, which means if the banking system now fails, equity market will fail, bond market will fail. Everybody dealing in businesses or receiving payments, even if they are not part of the banking system, they can be damaged. So negative externalities actually impact of a third party other than the shareholders and depositors. Now, the other thing why we need regulation is because of the market failure. Now, market failure, please understand it as a systematic risk. Systematic risk is just the collapse of the whole system. A drop in the equity market, drop in the interest rate, drop in the inflation, drop in the whole business cycle. And this is what we call it a systematic risk, which is a damage to the whole economy. Now, one more issue which I want you to understand in this stage, which is the net regulatory burden. As I told you before, look, for example, to the capital adequacy. Capital adequacy now is requiring each bank, which is the Basel requirement that we will talk about it later on. They are asking each bank and every bank in the world to keep 10.5% of their assets as capital, which means if you are going to finance any loan for $1, 10% of that loan should come from the shareholders. This is huge amounts. Raising capital is very expensive. And actually now it is 12%. Because if you add it's 13% if you add the buffers. So Basel come with buffers. So 13% are making European banks, like crazy. And they think more regulations will decrease their efficiency, which means, okay, you are giving me more regulations to protect the depositors and the bank. And in this case, you are actually decreasing my efficiency. This is from the perspective of the industry. However, the regulators or the supervisors or the government think more regulation is useful to the financial stability and the stability of the banking system. So I define now regulatory burden and I define net regulatory burden, which is actually the difference between, from the perspective of the banks, the benefits of more regulations against the cost of this regulation. If the cost overcome the benefits, then it's clearly a net regulatory burden. So this is why regulation comes to the picture and why we care about that. And it's because of the negative externalities and market failure. And I already defined what is the regulatory burden or the net regulatory burden. Now let's talk about regulations. Regulations, as I told you, are issued by the supervisors, and the supervisors is the one who take care of the banking system. In this country, you can talk about Bank Negara Malaysia. Bank Negara Malaysia is the one which is the central bank in this country, or you can talk about central bank. So Bank Negara Malaysia or APRA in Australia, which is the regulatory body, or Central Bank in Indonesia, Central Bank in Japan, wherever you are come from, the central banks are the one who take care of the regulations. Now, what are those type of regulations? We have safety, which means you have to take precautions, and you have to do some measures that prevent the failure before it happens. And then you have the monetary policy regulations, and you have the credit allocation regulations when they ask banks to allocate credit to the housing sector or the agriculture sector, then that comes to regulations. When they ask them also to participate on the monetary policy by going to this open market operations, it's another monetary policy regulations. Then we have also regulations, and it's actually active in Malaysia, consumer protection regulations. The way banks deal with their customers. There are a different type of regulations here. And there are also a protection for the investors. There is another set of regulations. And one of the most important thing is the entry and chartering, licensing regulations. Not everyone can get to the banking system. You can start any company now. It's very easy in Malaysia and most countries. But to start a bank, actually they make so, the application to start a bank, first, for example, in Malaysia, you need to pay around 1 billion ringgit as a capital from the shareholders or the establishers from the bank. This is before you receive any deposits. And therefore, the number of banks that are operating it's not monopoly or whatever, but they keep only the strong banks and the big banks who can actually survive and stay, because failures, it's not a try and error to go to the industry and leave. Going to the industry, they want only strong players. So this is the fifth regulation. Now, as you can see, why we do it, because of the services, and we are afraid of negative externalities, market failure, and that will involve integrity burden. And this is the six categories of regulations. As I told you, the safety, the credit. This is just repeating what I said here. Now, this is, it makes it, I really delivered the point I want to deliver in this part, but I just want to tell you that to give you more details. For example, safety and soundness regulations. First layer, an institution has to have good portfolios. They have to diversify their assets. You cannot give all your money to the housing loans or the commercial loans. You cannot give big loans, big disclosures to one firm, for example, 10% of the bank capital. In Australia, you cannot do that. You cannot lend to another company that is owned by the bank. So actually, the way banks invest their money has to go through portfolio, so they don't fail when they invest. So they have to invest in bonds, in stocks, in loans, different type of loans, and different type of securities and derivatives. So there must be a balance there, so there is no failure. Now, if you are going to give 10% or more, 10% or more than 10%, then in this case, a loan of 10%, more than 10%, you have to disclose it. And actually, you have to take an agreement by, you have to take an approval by the regulator before you do that. Now, the capital requirements, which I tell you now, It's now, according to Basel, is 10.5%, and you have to comply with this. And why capital, actually? Capital is very important because if you fail, and if there is too much risk, this risk will be started to manage by the funds, like when you have huge credit risk. Now, the first thing I will do is to see the provision of credit of that bad debt and charge to that account. But if the credit risk is high, and this provision already consumed or eaten by those risks, then the next layer is actually the capital. The capital can decrease, and you have to have enough capital. Because if the capital is then consumed in this credit risk and it's huge, then the bank will collapse. And we don't want the bank to collapse. So banks are required to have good capital. And as I told you, according to Basel, it's 10.5%, and it can come to 13% if you add the buffers. And we will talk about this when we go to week 11. Now, the third layer is the safety valves. And what is this safety valve? It's actually deposit insurance. They introduced already deposit insurance in this country to prevent the bank run. So every depositor in this country, and Australia, in the US, and so many other countries, if the bank collapse and they don't have any money, the deposit insurance scheme, which is in this country we have something called PIDM, will pay you up to 250,000. And by this way, there is some stability in the market. And the fourth layer is monitoring. Monitoring means banks have to provide reports. And central bank also has to send their people to check the banks. And so the banks provide reports in monthly basis, quarterly basis, and sometimes if it is under some type of investigation, they have to provide more frequent reporting. Editors have to edit the bank and send it to the regulator. The central bank, which is the regulator, also send their people to check the banks. So this whole issue of monitoring is very important. And so the banks keep monitoring so they know where the things are going, and they can take action in due course before the bank collapse. Now, this is the safety regulations, which is fourth layers. Now, money policy regulations, as I told you, in this country, for example, in each dollar you receive as a deposit, you have to make what we call a reserve. Central banks. Last time it was 4%. I think now, beginning of 2023, they have decreased this now to 2% of each dollar. And this one is like a tax. They don't give you any return. You just put it as safety there. So this is one of the issues. Of course, some other countries, it can come, I remember in South America and Central America, it can come to Brazil and some other countries, you can go to 30% when the economy is really bad. So this is a minimum of cash reserves. It can be by EBRA, which is the regulator, or Bank Negara Malaysia, or if you are from, you can check your country. If you are from other country like Indonesia, Korea, Thailand, Taiwan, Sri Lanka, you can see your country. We have also credit allocation regulation. As I told you, if there is socially important sectors, you have actually to give credit to those banks, to those sectors. And this is it may not give the highest return to the banks. It may be a little risky, but banks are regulated to provide to those sectors, even if they have had little returns. And this is for the total well-being of the society and the economy. Now, consumer and investor protection regulations. We have in this country regulations to protect consumers. And if you have any problem with banks now, you really can I mean, it's a big deal for me and you, but banks can go to have to comply with those rules of protecting the investors and the lenders, which is depositors. Now, entry regulations, as I told you, not everyone. In this country, we have what we call Financial Act 2013, Financial Institutions Act 2013, either for Islamic banks or for commercial banks. And it is, the license has to go from the Ministry of Finance, and the Minister of Finance has to decide on the capital, and the capital has to be 1 billion ringgit at least to put it when you start. Also, they define the scope and the work permitted, the activities. So the regulation will tell you this one, and they tell you who is allowed to get to the business. And they want, of course, the purpose of this regulation is to bring only the strong banks inside and the strong players so they can survive and not damaging the economy. This is just explanation of what I have said, but actually, if you look at this and this and this, I'm really done with this part. Thank you very much. You can read this one. I'm just the, this is just the, some explanation about it. This is one more thing. So in Australia, for example, the regulators is actually the EBRA, which is this one, and you have the Australian Securities and Investment Commission, and you have the Reserve Bank of Australia. Now, this Reserve Bank of Australia looks like our bank called Bank Negara or any central bank. But in Australia, Bank Negara, what we call the Reserve Bank of Australia, are not supervising the banks. They already in the 1993 come with this guy, the EBRA. EBRA now is licensed and established by Reserve Bank of Australia, and they are also do the supervision activities of the banking system. This, which is the Reserve Bank of Australia, which is a central bank, only currently take care of the what we call monetary policy. They are not taking care of the supervision of banks. And then we have all those three of them, and they have in Australia, for example, the Council of Financial Regulators, which is actually the three of those. Identities. Thank you very much. And this is the end of the lecture and the week one. Thank you. And I will see you in the tutorial and in the next recording. Bye-bye for now.